Run it hot. That's the modern-day colloquialism used in financial media to describe running a high-pressure economy. One where inflation is allowed to run over target, as long as high growth and strong employment come with it. Those most vulnerable to inflation might find it a poor pairing, but the most recent FOMC meeting has made it clear that monetary policy is adjusting course to a path that carries a lot more risk. But whether or not you're a fan of the strategy, history tells us something important. Gold and silver are set to boom in this environment. If you value unique takes on precious metals without the hype, you've come to the right place. Join us each week for fresh insights, and please consider subscribing to support the channel. Thank you. Arthur Okin was an American economist who wrote his seminal paper on high-pressure economies during the 1970s, and he was a proponent for a controversial and ultimately ill-advised economic policy. The idea behind a high-pressure economy is that it's an acceptable trade-off to sacrifice low inflation on the altar of growth. He believed and advocated for running the economy hot through loose and excessive fiscal and monetary policy to create upward mobility for marginalized groups. By running the economy hot, the theory goes that unemployment rates could be driven extremely low, which would give the advantage to workers in negotiating for favorable wages. If growth outpaces inflation, everything's fine according to this theory. History shows us what happened next. The 1970s were not characterized by a renaissance for American workers, but instead by a phenomenon known as stagflation. High unemployment paired with high inflation. Running the economy hot failed to produce the results Arthur had hoped for. Ideas never quite die, though. Some rise again like philosophical zombies from an oversold cemetery. And decades later, we began hearing about the idea of running the economy hot again, especially during Janet Yellen's tenure as the Federal Reserve Chairman after the 2008 crisis. And with the most recent FOMC meeting, it seems that a high-pressure economy is once again in the cards for policymakers. Now you might be wondering, what does this have to do with policy today or gold and silver? And before we get too much further into the weeds, let's take a look at the numbers. Not only did the economy underperform in the 70s, but gold took off from its baseline price of $35 an ounce at the finale of the Bretton Woods Agreement in 1971, and it culminated in a 2,400% price increase, reaching about $850 an ounce in 1980. However, we need to add an asterisk. Gold's rush to $850 was not due solely to the monetary policies of the era, but also due to geopolitical mistakes that had accrued for decades. The gold standard had set a fixed rate of gold of $35 per ounce, and when that ended with the Bretton Woods Agreement, gold was free to float to market rates, and there was a piper to be paid from decades of suppressed inflation. So we can't say the high-pressure economic theory was the definitive cause that gave us a 24 times return over a decade in gold prices, but we can't discount its contributions either. The 70s was characterized by double-digit inflation, and that was a direct contributor to demand for gold, which also helped move the price to its record at the time. The FOMC meeting on September 17th this year was unlike any other, as the board convened during strange times. An appointee from President Trump, Stephen Myron, was at the table, and he wasted little time advocating for substantial rate cuts to boost the economy. If you've been a follower of monetary policy over the past year or so, you'll know that Chair Powell has been under pressure from the Trump administration to cut rates. A tactic only hesitantly endorsed by the board. Cutting rates now, while inflation is currently rising, seems unwise. But the Federal Reserve's dual mandate demands the labor market receive equal consideration, and it has become known that prior employment numbers were overly optimistic. The job growth in this country has been anemic at best, and we're getting close to crisis as the job gains in the economy fall below the replacement rate needed to sustain the labor market. The Fed is now forced to respond to two risks that are rising at the same time: unemployment and inflation both increasing. And although recent history seems to suggest inflation is a greater threat to economic prosperity, the notion we should run the economy hot is picking up steam for a surprising reason. There's arguably a third unofficial component to the dual mandate, and it has to do with our debt. Some believe President Trump wants rates lower to juice the economy for political reasons, and that may have some merit. But there's also a financial incentive. The interest expense on our debt is excessive and nearly unmanageable at current rates, with deficits of 6% becoming the new normal among developed nations, the US being no exception to the rule. Accepting lower rates in exchange for high inflation is becoming a necessity to pay the nation's loans. Not only is it beneficial for a country addicted to cheap financing to keep the rates low, but high inflation also has the effect of raising tax revenues, which keeps the beast fed. This need to manage our debt is one factor that's driven the president to put so much political pressure on the Federal Reserve. So while not a true component of the dual mandate, its presence has been felt nonetheless. It appears conditions have aligned for a repeat performance of 1970s era economic theory, and with it we expect gold and silver prices to respond. A 24x increase in the price of gold seems unlikely given current valuations, and it would be irresponsible for us not to point out that gold has passed its all-time record high even after accounting for inflation. For example, $850 an ounce in 1980, adjusted for inflation, is between $3,300 and $3,400 per troy ounce today. But nevertheless, conditions are favorable to push gold and silver higher, with some analysts advocating for $5,000 gold and new record highs well above $50 an ounce for silver. It's not just the one rate cut for 25 basis points that we had on September 17th. The projections in the dot plot are increasingly generous, with more cuts expected. Not only that, but Powell's term is coming to an end in 2026, and President Trump will be nominating a new chair for the board. Stephen Myron is trying to sell the vision for an additional 1.25% reduction, the equivalent of 5 cuts by the end of the year. This doesn't appear likely, but it does signal where the Fed is heading in 2026. Make no mistake, with inflation hovering near 3%, well above the 2% target and continuing to trend upwards, a series of rate cuts will move that number higher. And with advancements in AI, it's not entirely clear that greater employment will follow. The conditions for 1970s era stagflation are materializing before us, and it will require careful management to avoid a repeat of history's errors. And in the meantime, gold and silver stand to benefit from what's going to be a rocky road. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.